Good morning, everyone, and welcome to our Cash Flow Management Making a Hidden Resource Work for You webinar, sponsored by the Orange County government. My name is Teresa, and I will be your tech support and organizer for this webinar. Our presenter today is Jose Molfino, consultant and area manager with the Florida SBDC at UCF in Lake County. The Florida SBDC Network was established in 1976 by the U.S. Small Business Administration to provide technical assistance to small businesses. The Florida SBDC, our network is a nationwide network, part of small business development centers with nearly 1,000 local centers across 50 states and U.S. territories. We are funded in part by the U.S. SBA, the state of Florida, and local economic development agencies. We are state designated as Florida's principal provider of business assistance, and we are nationally accredited. The SBDC has been around for about 45 years, just over. We have offices throughout Florida, ranging from our headquarters in Pensacola all the way down to our Keys, with each region being hosted by a different university or state college. In Central Florida, we are hosted by UCF. And within our region, we are supported by local state colleges. While our lead office is in UCF, we also cover 8 counties: Orange, Seminole, Osceola, Lake, Sumter, Volusia, Brevard, and Flagler counties. Now, our main services include our no-cost expert confidential one-on-one consulting. That is our primary service, but a really great thing to come and speak to our consultants about is our market research. And with connections between the Florida SBDC Network and UCF, our consultants really have a great extensive access to market research, which is no cost to you through the services we provide with our consultants. Now, we don't stop when you start. Much like the program today, we continue to support your small business through many stages of growth. Beyond training and our consultants, we offer special programs for second stage businesses within our region, programs like our CEO Exchange, Advisory Board Council, and our award-winning Small Business Institute. And last but not least, we do offer a wide variety of business training seminars and webinars for all stages of business as well. Now, before we get started, I do want to cover a few housekeeping things. Your mics are muted by default, so if you have any questions, please feel free to use the question chat box feature in the GoToWebinar panel at any time. This is a relatively shorter presentation, so we will address the questions at the end of the presentation. That being said, we do prefer to collect questions as we go, and because the questions are sometimes can have a delay between when you send them and I get them. If you can be as specific as possible in your questions, we would greatly appreciate it. Please do not use the raise hand feature if you do see it. You shouldn't see it, but if you do, please realize we can only take questions and comments through the questions box. Copies of today's presentation can be found as a PDF in your handouts tab on the GoToWebinar panel. Last but not least, the evaluation survey link for this presentation will be emailed out to you about an hour after this program finishes. These surveys are really important information that we gather not only on the presentation and the presenter itself, but also it expresses your interest so we can continue to plan programs that are important and beneficial to you. So please take a few moments to fill out the evaluation when you receive it. It would be greatly appreciated. Thank you all again for joining us. And without further ado, I'm going to pass it off to Jose and we can get started.
All right. Thank you so much, Teresa, for the introduction and presenting the SBDC and the services we offer to the business community. I have been with the SBDC for around 5 years. I started as a volunteer advisor for one of the successful programs they ran, the advisory board council. And I would say a year and a half ago, I joined the ranks as a business consultant, especially with the COVID pandemic hit. hard on the business community. Now I'm managing the Lake County office, offering services for all our clients in Lake County, and as well for the rest of the counties in Central Florida. So today I'm going to go through basic concepts of cash flow management and forecasting, and probably it's going to be a short presentation. My focus is on answering any of the questions you might have about what is cash flow, what is important for the business, and how we can master this important tool. So let me just cut my webcam so I don't have any issues with the internet connection. And then I will go through each of the slides. I cannot move the slides, Teresa.
Try going back to your PowerPoint and try clicking on that, and so that the top.
Yeah, I have it. All right, our agenda for today is explaining what is the 5 stages of the business growth. This is an important framework to understand how cash flow tool is affected in each of the stages. Have a quick definition of cash flow, what is the cash flow cycle, the importance of the financial statement, how to prepare a cash flow projection, and all the other services and research materials we can provide you in case you need to consult with us. And we ask you to come and visit us. As Teresa mentioned, this is a no-cost consulting, so we are happy to have you in our office or have a virtual meeting with us. So there was an important, I believe, research many years ago about how the business, in general, the small business especially, what is the journey of the business through the years. And there was a good level of data that demonstrated that in general, any type of business will follow more or less a 5-stage journey. Not all the business will go through the 5 stages. Some of them will stay, on stage 3. Some might even stay in stage 2 for many years, and some of them will stay in stage 4. As I said, not all the business are expected to go through each of the stages. And the idea is that it all depends on what is the owner intrinsic motivation, basically, and how the owner migrates through the different stages in the way of managing their business and in the way of delegating part of the business activity. So in stage 1 is basically what is a new business. It's the owner is basically doing all the activities in the business. You are working in the business as a main concept because the owner is going to do most of the activities there. It's a business that is just acquiring customers and is testing if its product and services are working. Basically, if you have a manufacturing, you have to make sure that your manufacturing and your final product is really up to expectation and the quality aspect that will hit the market and the customer will like. And therefore, it's a stage where mostly you will be consuming resources. Therefore, your expenses will be higher than your revenues at this stage. So it's expected that you are not making money at stage 1. In stage 2, you are able to really get customers in your business, right? You are growing your customer base, your product and services somehow are, you are producing the quality that is expected, and the customers are really acquiring your products and services at a faster rate. You still are not making money, or you are reaching the break-even point, meaning that your revenue and your expenses are similar. And this is a stage where you will see many businesses survive for many years. It's typical for the mom and pops, where they are making an income through salary. Many of the owners are making salary, but they are not making profits, or profits. Some months are positive, some months are negative, and overall they are happy on earning a salary similar to the one they can get working for somebody else. In stage 3, the business is becoming successful. Revenues are higher than expenses, and therefore, you know, the business it's having a high level of customers. The product and service is already proved, and the organization is starting to grow. This is the area where you will see owners hiring more people and really, you know, making a decision. And this decision is if the owner will disengage from the business, or he will keep the business growing to the later stages. Many businesses stay here in the disengaged part. The owner is happy with the money that he's doing. The people that he or she has hired are managing the business well. So this business can go on for many, many years. The business is profitable, as I mentioned. The stage 3, part 2, which is the growth, is when the owners say, no, I want to go more, and probably I want to open a new location, or go to a different state, or even export outside of the US, or opening a location outside of the country. So that's where the growth starts. Go to the takeoff stage, where, you know, the business has been successful in multi-location and multi revenue in terms of different verticals, and maturity, where you have a big business that is very well managed. I'm doing this introduction because it's important to understand how cash flow will change through the business journey. And this is more or less what the cash flow will look like in the different stages. And we have 3 main indicators. The first one, if cash flow management is critical to a company or not. If it is important, but you can manage it, or it's somehow irrelevant to work on the cash flow. And you can see, you know, the first 2 stages is critical to the company. In my experience, and all the statistics will show you that many businesses cannot make it past the stage 1 or the stage 2 because they run out of money. Not because the business was bad or badly run, but they didn't have time to get the business profitable. And that's basically, you know, they didn't have enough money to keep going until they break even and start making profit and move to a stage 3. So cash flow is super important in stage 1 and 2. In stage 3, which is disengaged, the business is making money. So the owner doesn't really get into the detail of that, because the way it's running it is producing income, is producing profitability, and therefore the cash is coming by itself. So there is not really, you know, it's not critical for the organization to manage the cash, because the cash is coming by itself. Now, when the decision to grow comes, that's a different picture, because now you are going to invest more in the business. You are probably going to open more locations. You are going to hire more people. You are going to buy more inventory. most of the time the cash that you have in the business is not enough, and then you have to consider getting money as a loan or bringing investors. So that's where cash flow starts to get critical again in the takeoff part, because you are really investing a lot of money in the business, and you need to make sure that either you are not growing too fast, and the cash that you have on hand, it will be enough to manage the operation. And then on maturity, the business is back again to a stable type of revenue. It is mature, but because of the big size of the organization, it's not critical, but it's important. Everybody will take a look at the cash and all the indicators that the cash can in order to keep the business successful in the long term. So what is cash flow? At the end, the simple thing in cash flow is making sure you understand what are the inflows to the business. It's basically what is hitting your bank account. Everything that is coming into your bank account is positive cash flow. Anything that is coming out of your bank account is negative cash flow. And the idea is really to, especially in the stages where cash flow is so critical, is to have a proactive management of the cash, making sure when the cash will hit your bank account, when it's exiting your bank account, and that in the long run you will have more cash coming in than exiting your bank. And that is important to understand what is a cash flow cycle, and that's as a simple definition of from the moment that the cash exits your bank account to invest resources in order to generate income. And the resources could be, if you are manufacturing operation, buying inventory. If you are offering services, paying your people, the payroll that is generating those services, for example. So all the activities that goes into the whole process until you are generating a sale. And in that part, in the first part, until from the moment you invest in your resources, you have different type of vendors where you define if you are paying cash, or if you are paying 30 days, or you are paying 60 days, or 90 days. How you finance your operation in this part is important, because that if you are financing part of your operation through your vendors, that will release some of your pressure on your cash. The other part of the cycle is from the moment that you invoice until the moment you collect. So it's how quickly you can get the money back after you render the service or deliver the product to your clients. As I mentioned, cash flow will have inflows, and the main inflows are sales. If you are getting loans from the bank, the moment that the loan enters your bank account as a cash inflow, any new investment, people that invest in your business also will contribute cash to your business, so that's an inflow. If you are selling assets, also the sale of that asset will get you money, and the profits that your business is generating. Outflow is when you buy inventory, when you are investing as a business, when you are paying back debt, or when you are paying back yourself. The objective is basically in the long run to have positive cash flow. So as I mentioned, in the first two stages, most probably your outflow will be higher than your inflow. But as you go through that journey, you are not surprised that when you are going to turn the tables and generate more cash that is exiting. That is why the cash flow forecast is so important in the stage 1 and 2. It's making you aware of what is coming, diminish the surprises to your business, and prepare for a contingency plan in case you're going to extend the time until your business becomes positive. So you prepare yourself for plan B, plan C, plan D in case you need more cash for the coming months. So the cash flow management, it's really at the end understanding your numbers and how your business operates. I mean, what is the financing capabilities that you have with your vendors, for example. If you are able to change from paying cash to paying the vendors in 30 days or 60 days, that is a very good management of cash flow, because you are getting finance with zero interest most of the time from your vendors. If you can collect sooner from your customer, also it's decreasing your cash needs. If you don't run too much inventory, for example, instead of having 60 days of inventory, if you have 30 days of inventory, you will need less cash to operate your business. So basically understanding your numbers, understanding your income statements, how much revenue do you have, if you need, for example, if in this environment of inflation, if your cost of goods sold is increasing because you are paying more for your raw materials or the services that you are acquiring, how you are transferring that in terms of price increases, for example. So understanding your income statement and the components of your income statement, especially on the top line, revenues and cost of goods sold, is important to understand how much cash you are going to use. Balance sheet is another statement that you need to know very well, because that's where your debt is there, how much interest are you paying, what is your account receivable, how fast you are collecting, and what is your accounts payable, how late you are paying. And I'm not saying that you have to pay late, but you know, how many days of credit term do you are able to negotiate with your vendors. So all those statements are important. So at the end, you need to understand very well your numbers in order to accurately manage your cash. The key for cash flow projection is, as I said, having your statements, understand them. Some historical information is key, because the more you know about the past, the better you will be able to project in the future, and understanding how the business works. I normally like, for example, when I forecasting a cash flow, break down the revenue line as much as possible by item, and by volume and by price. So that's way I know what is the volume that any type of business needs to sell, what is the price they are selling that product, and what is the top 10 product they have. So most of the time, you know, a few products or services will make 80% of the sales. So, you know, understanding what are the top 10 sellers and how they affect the overall revenue of the business is important. So as I mentioned, it's important that the business understand the financial statements and how the statement come into life. It's a simple concept, but it's a powerful one. Whenever you start a business or buy an existing business, what the owner is doing is basically buying assets. So those assets, when the owner is buying those assets, it's basically he has to pay for those assets by using third-party people or money, which is the liability part, and using their own money, which is the net worth. So the way you pay for the asset is by loans, which is liability, or net worth, which is the owner money or any type of investors that is coming into the business. So what is the expectation? That those assets will generate sales. That's the idea. And the sales should generate a positive net income. And how you are going to use that net income? Basically, 3 ways. You buy more assets, you pay back the loans and liabilities, or you pay back the owners of the business. So the balance sheet is explanation and what are the assets that the business has and how those assets were bought and how they are maintained. Basically, how much is liabilities, how much is net worth. The income statement is everything that has to to do with sales and net profit. The cash flow will always be a combination of both because it has some components of the balance sheet, it has some components on the income statement. So it's important to understand those statements in order to have a good cash flow exercise. This is an example of an income statement and business. Normally, you want to have around 3 years to have a good set of data and see how the business works. In this case, for example, this business has gone from $1.5 million in year 1 to $2.1 million in year 2. That's an important growth. But their cost of goods sold have gone from $1.2 million to $1.7 million. And here we start working about ratios, right? So this business, cost of goods sold in year 1 was around 79% of the sales. Now it's more 82%. So there are a few percentage points that has increased. So the cost of material has gone up, but as a percentage, that means that the owner has not been able to transfer that increase in cost in the top line. So that is putting pressure on the income statement and most probably will put pressure on the cash flow as well. In the expense line, for example, has gone from 250 to 346. It's expected that you will use more expenses because you are growing the business. But in terms of percentage, it's gone from 16.7% to 6.38, and that's what is expected. So as a percentage, most of the expenses will be fixed costs. So as the business grows, I would expect that the fixed costs will remain the same in the majority of the items. Not all of them, but you know, you should be more efficient the more volume that the business sells. And the income, the net income has gone from $54,000 before taxes to $6,000. So it's growing in sales, but it's not generating enough profit, and even it's decreasing the profitability. So as you can see, it went from 3.6% to less than 1%. And easily you can see that the problem was in the cost of goods sold because the business lost 2.5% points, which is, you know, the points that they lost in the income statement going from 3.5 to 0.30. So that's important to understand the numbers and how that is going to affect the cash flow. In the balance sheet, we can see the same. Account receivable has gone up. That's what is expected because it's selling more. Inventory has almost, you know, gone twice, which probably is a signal that is something might not good there. A lot of use of cash there. Fixed assets have gone from 223 to 376, so it's investing in assets. Liabilities, you know, have gone from 255 to 734, so it's financing more of the assets with liabilities. On accounts payable, it's doing a good job because it's going from 100 to 300. Expectation is increasing the payment terms instead of being late. We will see that later on. And you know, the notes payable, which is short-term, normally short-term financing, and has gone from 52 to 282. Long-term debt has gone down. So normally, when you are growing sales in the long term, you want to also finance that with long-term debt instead of short-term debt, especially on the lender part. It's okay to finance that with payables because you want to increase your payment terms, but it's good if you are going to increase your debt, increasing in long term instead of on short term. Account receivables are increasing because it's selling more, but it's having an issue in terms of collection. Current, I would expect that 90% of my account receivables are current, and in this case, it's not the case. So this business has to do a better job in terms of collecting. $100,000 is over 90 days due, and that's An account, an account payable is paid late. That's not a good picture. I mean, the business needs to really increase the payment term by negotiating with vendors, but paying late is a bad image because it will affect the credit of the business in the long term. So this business has $300,000 of accounts payable, but 2/3 of that is late. It's not a good image. So we are entering in the cash flow projection. This is an example of 3 months, but normally I would project your cash flow by month, by week, by month for 12 to 24 months at least. And the way I project the cash flow, I break cash flow into 3 main items. One is cash flow from operations. So I want to understand how the business is working from the operation part, meaning I really want to understand how my collections are coming, how my purchases are coming, mainly of inventory or cost of goods sold, and then all my expenses, right? So in this case, my cash flow from operations, it's 422 the first month. Negative is outflow, positive is inflow. So this business is starting, and therefore it's paying most of the inventory at the beginning of the month, and later on it will keep going on the current level of payment. So it's having a lot of money outflow at the beginning. This is probably a new business, and therefore it's expected that at the beginning it will consume a lot of cash flow because it's ramping up the operation. The second part is what is called cash flow for financing activity. So if this business is consuming $561,000 of cash in the first 3 months, how I'm going to get that money in order to pay that imbalance? So in this case, this business got $800,000 from loans. It started to pay the interest rate and amortization in the next month. So overall, it will generate in the next 3 months $763,000 from financing, which is enough to cover the outflow from operations. And then the third item is called cash flow from investing. So what asset is this business buying or selling? If it's negative, it's buying. If it's positive, it's selling. So assets, in this case, it bought $45,000 in assets. So cash flow from investing activities was $45,000. So the net cash flow is going to be positive the first month, negative the next couple of months. But the business started with $5,000 plus the $332 from month 1. It should have $337 in the bank account, and so forth until it goes down to $161 by month 3. So for a business that is in stage 3, it's expected that the operating cash flow should be positive. It's a business that is already generating cash from the operating part. In the stage 1 and stage 2, you will see that most probably cash from operation is negative because it's ramp up the business until it breaks even, and then it starts generating positive cash flow. The timing is important because, as I mentioned, when you are collecting money, you might collect some of your customers. You can collect cash. A restaurant will collect cash directly, for example, or in 7 days if it's a credit card. But some money might be collected 30 days later, 60 days later. It depends on the credit terms that the business offers. So that's the difference between the income statement and the cash flow. The income statement will register the income when the business invoice. The cash flow will register the income when the money hits the bank account. So the time of the money is important. So this difference is what it costs to collection, and in case of purchases is the same. I mean, you can receive the service today, and in your income statement the expense will be today, but you might be paying that 30 days or 60 days later. So your bank account will be hit 60 days later, and that's going to be a difference versus what you see in an income statement. So it's important to have a dashboard of the main metrics. This is what we call a scorecard of the main metrics to manage cash. How much cash is in the bank, what is the revenue versus what you expected, your account receivables, your accounts payable, the payroll. So understanding what is the main cash component of your business and try to establish a scorecard for them to make sure that you are able to manage properly your cash on hand. With us, we will work with you in having a kind of ratios and building that scorecard. These are very good ratios to manage your business, not only because you understand your business numbers, but also we have the ability as a SBDC, because we have access to many databases which provide benchmarks. So we can tell you if the level of inventory that you have in your business is aligned to the rest of that particular industry. So in this case, for example, this business might have 64 days of inventory 2 years ago. Right now, it went back to 44 days 1 year ago, and now it increased to 86 days. That's what we saw when we saw that the inventory went from $200,000 to $400,000. So it's keeping now 86 days of inventory. The industry is keeping 74 days. So that is good comparison to see if the more inventory the business has, the more cash has invested into the business. In this case, it's almost 12 days more of inventory that is using the cash resources. The same thing for accounts receivable, for example. This business is having 45 days of account receivable, the industry is around 40. So having that type of metric, that type of comparison is very good, and we can help you putting them together in order to manage your numbers and the effect of those numbers in your cash. I wanted to, go and make this presentation short so you can ask any question. And we are here to help you. As Teresa mentioned, we provide no-cost consulting to you. We will help you on understanding what is the main assumption for your business. We can help you to do a cash flow forecast. We have tools to do that. We can provide you a benchmark of your business and compare that with the industry. We can do evaluation. We can help you to put together a budget. And we have other also consultants in the organization that are experts in marketing and sales, and exporting and government contracting. So we are a group of business consultants that has a lot of experience, not only having been business owners, but also having worked in big corporations and mid-sized companies as well. So please get in touch with us, and we will be happy to help you. So if you have any question, I'm going to be here until the end of the hour. So Teresa, back to you.
There is one question. One of our attendees is wondering if there is an editable example of the income statement you shared in your presentation.
If it's what is the question again?
You shared on one of the slides, you shared an income statement, and they were wondering if you had a editable version of that income statement that you could provide.
Yeah, absolutely, absolutely. Yeah, I can do that.
If you want to reach out to us by email, I will add our email addresses and within the chat box so that you can reach out to us. Oh, Jose
Yes.
has it in the presentation already.
Yes.
I will copy that to the chat box as well so that you guys will have it, and go ahead and send them an email and let them know if you would like a copy of that income statement. And that right now is so far the only question I'm seeing. Okay, another one just popped up. This person says they are so new, this is their first seminar, and they're a minority family. Are there any nuggets for someone like themselves?
Well, it's important to really understand the stage of the business journey, because that defines many things on how to make optimal use of resources, not only in terms of financial resources, but also strategic resources and marketing and sales. So any type of organization should have three strong areas in the business, and those three should be sales and marketing, finance is the second one, and operation is the third one. At the beginning, the business owner will do all of them, and as the business grows, it will hire people to manage each of those functions. But it is important that if the business owner do not have the capability on some of those areas, find someone who has the capability and join forces to make sure those three areas are strong all the time through the whole journey. There will be more tools that the business will use in each of the stages. I mean, you can do probably at the beginning just a quick income statement, a quick cash flow. In a stage two, most probably you want to have an accounting system in place, right, where you can monitor your numbers on a monthly basis at least. And you can start with a simple version of QuickBooks, for example. Once you are in stage three, you want a more advanced version of QuickBooks because you want to start doing budgeting. So that the simple tool will not have that capability, but the more advanced tool will have the capability to start doing budgeting and help you forecast your income statement down the road, which will help you forecast your cash flow as well. So different tools for different stage. You don't want to have a huge organization in stage one. You want to have a better organization in stage three, for example. And if you decide to grow and go for stage 4 and 5, your type of organization is different, right? If you, as a business owner, wants to remain on stage 3 disengaged, you want to hire professionals, for example, that will run the business well, but they don't have expectation of a career growth, and they have a lot of ambition in terms of growing their career in the future. If you want to go for a stage 4 and 5, the type of people that you want to hire is different. Those are the ones who want to have a career because your business will migrate to a much larger organization and you can offer those opportunities. So those are some of the stuff that we discuss whenever we go into the different stages of the business journey. We work through the whole set of tools for each set of business journey.
Thank you from both myself and the attendee who asked the question. I don't see any more questions, so if you guys have typed something into the chat box and maybe didn't push the enter button, just to let you all know, that was the last question that I see. But we will hang on another moment and await further questions. So one just popped up, is there a way I can meet with someone in person? We do have, I'm not sure if you were here at the beginning of our presentation. This is the Florida SBDC at UCF. We do cover an 8-county region within Florida, And you can find the registration on our webpage. I'll add it to the chat, sbdcorlando.com/consulting. Just go ahead and fill out that registration information we will need to take before you meet with anybody, but you can speak with somebody one-on-one. And depending on where you are located, that will depend on whether or not you can meet with someone in person. Also, because I believe Seminole County has had some flooding in their area, so that might be affected that as well. So I'll add that to the chat. Go ahead and register, and then we will, and then we'll be able to set you up with somebody who's closest to you. I'm gonna go on mute for just a moment while I type that, so you don't hear the typing sounds. But if you guys have any further questions, please type it in the chat box, and we'll get Jose to answer it.
Yes, and we have offices all over the 8 counties that Teresa mentioned, and we offer both type of assistance, virtual and in person. So we have Zoom meetings for whoever wants to meet with us on a virtual one-on-one, or you can reach out in any of our offices for a face-to-face conversation as
well. Okay, you all should see in your chat box Jose's email address as well as the website to register to speak with one of our consultants. And the registration page is throughout Florida, but because of the magic of systems, if you are in our area, you will be forwarded to your local county of the address that you put in. I also want to remind you that before you leave, go ahead and download the handout from today's presentation. The handout will also be included in as a link within the survey. So if you can please fill out that survey, the email that it comes in will also have the link to this presentation, to the PDF presentation for you to download later. But it's usually better to get it now, just in case it gets lost in your email. And we're hoping it doesn't get lost in your email, because we would really appreciate those responses in the survey. Right now, that's all the questions I am seeing. Okay, Jose, I think that's all the questions that our attendees have right now. Is there anything else you'd like to leave off with before we close out the webinar, or anything else you'd like to say before we go?
Yeah, I mean, reach out to us. We are here to support the business community. Our mission is to help the business community grow and succeed. And as Teresa mentioned, we don't charge anything for our services. So don't hesitate, reach out, and we will be there for you. Thank you so much for your time. Appreciate it.
Thank you, everyone, and keep an eye out for the survey that will come in to the email that you registered for today. And we look forward to seeing you guys either in one of our consulting sessions or in our next webinar or seminar. Thank you all again for coming, and we hope you have a wonderful rest of your day.